Good morning, good afternoon, and good evening, all. Just letting the last amount of folks all sort of filter through. So we've got quite a packed house today with over, I think, about 250 registrants. So great to see everyone turning out, especially this time of year. So those in the Northern Hemisphere building up quickly to the end of the school year. So all that's on your mind really should be school holidays and where you're going to have a good break. My name is Brett Evans. I'm the Managing Director for the Europe, Middle East and Africa region for Atlas Wealth. Just while we're sort of just waiting for the last month stragglers to come through, can everyone just confirm whether they can see my screen in terms of the presentation? Yep, fantastic, guys. Great. Okay. Right, yeah, we have a quorum, as they say, and let's get the show on the road. I do send apologies, by the way. My colleague Adam Prentice, who was meant to be joining today, isn't well. So Adam, get well and hope you recover quickly. No presentation would be replete by a regulated financial services firm without a few disclaimers. So here we go. We're going to get this out of the way quickly. I'll summarise this for you very succinctly. All the information that I'm going to talk about today should be treated as informational and educational purposes only. Please do not construe this as financial advice. If you do need to seek financial advice, personal advice, then please speak to a specialist like Atlas. As a dual regulated firm, we obviously, as well as being two regulators, we have two disclaimers. So this here is our DIFC regulatory disclaimer. Not many have this. We're actually the only Australian firm in the UAE that is actually regulated locally, and we're very proud of that. So what we're going to talk to you guys about today, well, we're going to pretty much run through some of the key tips and trips, but I'll give you a bit of the 30-second elevator speech when it comes to who Atlas is and what we do. We're the leading provider of Australian expat financial advice, tax, mortgage, and asset management services. This is not our first rodeo. We've been doing this for close to 14 years now. We've got lots of regulators, which means that the advice we provide to clients is highly regulated, which is your protection, not ours. We've got clients in over 50 countries. So lots of amazing people doing amazing things in some wild and wacky locations. To date, we manage over 350 million in assets for clients, and everyone you speak to from an advice capacity, whether it's on the financial planning side or the tax side or the mortgage side, is degree registered and in their field, in their particular field. So what it means is these people weren't doing some obtuse career before they decided to jump on the call and talk to you good folks. So we've got a lot of history, a lot of experience in providing advice to Australian expats, and we're very proud of that. So what are we talking about today? Well, first of all, what's on the horizon? Obviously the election's done and dusted, so we'll run through and have a chat about that. Next thing is, obviously Labor's floated a lot of policies in the years gone by, and we're going to talk about what that looks like and where this is going to go. Obviously, Labor's influence on property prices, Labor's influence on share prices, and last of all, end of financial year tips and tricks. Then, most importantly, at the end, we'll be doing our Q&A. So as I'm talking, so you don't forget to ask the question you need answering to, please hit the Q&A box down the bottom and put your question, and then right at the end, I'll circle back and run through those questions and give you the answers where I can. So 6 years of Labor, and this is something that we've got to get our heads around. Obviously, not only did Labor win, but they won by a landslide. And not only did they win by a landslide, it caused a lot of destruction in the coalition. As we saw, we've now got a new Liberal leader. Then we have the Nationals and the coalition, the Nationals and the Libs split. Now they come back again. So this is something that we're going to have to really contend with. And the chance of the coalition, now that they're back together, putting together a concerted effort, excuse me, in opposing the Labor government at the next election in 3 years' time is pretty slim. So what we've been telling clients is get used for 6 years. Some people have said maybe longer. Who knows? We'll see what happens. There's a lot of water going under that bridge. But 6 years to us is probably the realistic time frame that Albanese and his team will be in. And we now need to, you can't just stop managing your finances because someone's in you don't like. We have to embrace whoever wins and lean into what they're doing, and then be aware of what they may do, which may adversely affect you. So, as I said, good chance that Labor will be in for the next 2 years. We may be going into a Hawke-Keating period time. system, which hasn't been seen since 1983. And if you cast in mind back, for those who are alive, and if you weren't alive, you might have read about it, there was a lot of reform, a lot of changes that went through. And the reason being is when a government has such a large majority, they can afford to, I guess, annoy some of their constituents and lose votes, but still get the policies through that they want to get through. And the latest numbers I saw that Labor can still lose another 20 seats at the next election and still win a majority in the House. So they've got a lot of wiggle room. Whether they do it the first year, I don't think so. I think they'll let the dust settle. But certainly we wouldn't be surprised if over the next, at least after this year, 5 years, we might see some very big ticket topics starting to hit the stage. So tax proposals that Labor's floated in the past 5 years. Well, TGT discounts reducing from 50% down to 25%. How this affects expats, not really, to be honest with you. It's more of a domestic issue. Obviously, if you own a property in Australia and you hold that property for greater than 12 months and you sell it for a profit, you only pay tax on 50% of the gain. Labor has talked in the past that they might actually reduce this down to 25%. So obviously the narrative will be trying to reduce the speculation in property, reduce the housing costs, all those sort of things. So free up supply. So watch that space. That's ones we put at the top there because I think that's quite an easy one for them to pull off. Obviously, negative gearing restrictions have been previously proposed. This is one that is very divisive. Obviously, those who have multiple properties would disagree. Those who are trying to get into the market agree. Now that I always get this confused, Gen Z and Gen Y make up the bulk of the voting base. That's a very appealing market to go after. So if they think they can strengthen their position by appealing to those parties, then that may be on the cards. What politicians like to do is leak information, whether from Treasury or whether from the Cabinet, and test the market, see what the temperature's like. So what we're seeing right now, we saw this happen earlier this year, then it went very quiet. This may come up again. And how it looks, nobody knows. I mean, it might be a situation of, are we capping out negative gearing to 2 properties, or are we capping it out completely? Are we getting rid of it completely and grandfathering all those in the past who have used negative gearing? So think of like when capital gains tax was introduced back in 1983. When they brought it in, 1985, when they brought it in, all those people who bought assets prior to then were capital gains tax free, and all those people who bought assets post 1985 accrued tax on it. So it's actually not that hard to work out, but the devil's in the detail, and we'll see what happens there. Superannuation tax concessions for high balances could be tightened. I mean, if you're reading the Australian press right now, you know the $3 million taxing rule is a very big topic of discussion. And while I don't necessarily disagree with it in principle, I disagree with it in its detail. And what they're proposing is any assets that you have inside super that are greater than 3 million, if those assets do create a gain, whether realised or unrealised through the financial year, you may pay tax on it. So it does create a lot of, I guess, consternation with a lot of superannuants. And the reason it does that is, let's say, for example, you own a property or a number of properties inside super, and that property goes up in value. So how do you pay the tax bill without selling some of the property? And you can't sell a balcony off. So, like we've seen with a lot of politicians and a lot of policies over the last 10 years, it doesn't really get thought out properly in terms of that. I've got no issues at all with, the people who do have extremely large balances in super. This week, we saw in the Financial Review came out that one person's got $2 billion in their super fund. So there are some very large balances out there. But I guess the bone of contention is you're going against the premise of taxing something that hasn't been realised or sold. So we could see this spread out from super to other areas like principal place of residence, investment properties, and so forth. Where we're going to see from this is obviously the indexation topic as well. That's a big concern. While $3 million caps only really affect 80,000 people today, it will affect about 100,000 people to 150,000 people next year. And that number scales up like a hockey stick very, very quickly. So a $3 million balance today is equivalent to 500,000 in about 20 years' time. So by not indexing that limit, it will open the taxing regime to more and more superannuants as time goes by. crack down on trust distributions and high income tax planning. This has always been a bugbear of Labor, and now they've got the runway with 6 years to be able to do a few changes. We wouldn't be surprised if this is on their chopping block as well too. Whether they can get rid of it totally or reduce the concessions, we don't know. Once again, I'm sure as soon as Albo got back into government, he marched down to Treasury and said, start pricing up and start looking at these scenarios and modelling what they may look like. Greater transparency and compliance targeting offshore income. That primarily pertains to companies, but to individuals to a certain degree as well. And obviously not a Labor proposal, but changes the tax residency. We saw a bipartisan approach when that was originally presented by Scott Morrison. He almost got that through back in 2021. He didn't get it through because he lost government. Now Labor's picked it up. They've done a lot of work in the background. We were part of a consultation paper with Treasury back in 2023, September, October 2023, where they pretty much put it out to the world, give us your feedback on these proposals that have been made by the Board of Taxation. Our response to them was about 56 pages. I'm sure others were probably 500 pages. It was quite a loose proposal by the Board of Taxation with a lot of gaps. However, it went very quiet last year. So obviously by then Treasury were getting ready to build up to the election and they were taken off that project. Now that Labor's backed in, and obviously they've done a lot of pre-work on the residency rules in the background with Labor, we may see this come to the fore, and this may be one of the first cabs off the rank when it comes to changes going through. So watch that space. Obviously, the biggest thing you need to keep in mind is as soon as we see it, and we'll see it the date or even the hour that it gets announced, we will get it out very quickly, information out very quickly through our social media channels and our email chains and newsletters. So if you're not following us on social media, you're not registered to our newsletter, or not particularly, you're not a client, then get involved because our clients will know the first and then others will follow shortly after that. And then obviously we'd run seminars and webinars too on those topics. So let's have a look and see how the respective governments did through different asset classes through their time in government. The Australian Financial Review engaged CoreLogic, this is in the lead up to the election recently, and said, go back and look at all the governments back to 1990 and tell us which governments, where the property market performed well under which governments and where they performed poorly. And the Labor government has averaged 2.5% over the past, 25 years? No longer, 35 years. Liberal government's 8.8%. Obviously, little Johnny has skewed the numbers. He was averaging a 13.1% change over 11.7 years. So that has really ramped things up. But also too, Scotty from marketing, Scott Morrison, 9.7% annualised over 3.7 years, Turnbull 3.3, and Abbott over 9.1. I think Kevin Rudd's probably the only outlier there, but I think a lot of that is probably due to the fact that that was post the GFC, when there's a lot of catalysts there and a lot of cash floating around for property to grow, because obviously property needs that fuel of capital. So if we go through and break it down, obviously 2007 to 2013, resilient market post GFC, first time buyer grants, a lot of stimulus. So K. Rudd could probably take the partial credit from good policies, but also too, there were a lot of tailwinds that helped him there. Obviously 2013 to 2022 under the coalition, and strong growth, especially post 2019. COVID, obviously the RBA lent out $180 billion in cash to the Australian banks at 0.1% and said, give this to the market. And then obviously 2022 to present under Albanese, high inflation, rate rises, tempered demand rate remains high in major cities, but that's a supply and demand sort of scenario. So if we go back and look at Albanese, he's averaged 2.3% per annum over the last 2.9 years. Obviously, in that time, we've had a lot of geopolitical events going on, a lot of change of governments and so forth. So how has the Australian share market performed and under each party, and who does it favour? Well, no one. That's a surprising thing. So over the last 45 years, if we go all the way back to the date that the All Ordinaries Index was founded, so since January 1980, the difference between the two parties, 10.85% for Labor and 10.87% for Libs. So 0.02% difference between either party. And I think there's a lot of reasons for that. property, there's always tinkering in terms of policies. Main residence exemption turned on, turned off. 50% capital gains discount turned on, turned off for non-residents. The political parties can do a lot of that. With obviously equity markets, they're a global issue. So while there might be particular countries that do affect their local markets, the general consensus is if the US is on a tear and flying away, regardless of what Albo does, the Australian share market's going to follow suit as well too. So the share market or the equity market's a lot more decentralized in terms of its exposure to politicians, whereas property is very much involved in that at both the federal and the state level too. Like we've seen in Victoria over the last couple of years with their land taxes, we're seeing a bit of an exodus of expats selling their properties in there because of absentee tax, land tax, and all the taxes. Now they've reduced the threshold down to virtually zero. That's hurting the Victorian property market. So it doesn't matter what Albo is doing. If locally and at a state level there is a lot of issues, then investors will walk with their money. So when we go through and look at just all these different times, let's just start from 83 with Hawke into Keating. So annualised return 16.5% from 83 to 96. Johnny Howard, 96 to 2007, 14.3%. Kevin to Julia, back to Kevin, that tennis match. 2007 to 2013, obviously there's a big reason why that market's flat, 0.4%. That was the GFC, right in the thick of it. And then obviously Tony Abbott, Turnbull back to Scott Morrison from 2013 to 2022, annualised at 8.3. And then obviously Anthony Albanese from 2022 to today is 8.4%. So it's a nice reminder that when you are managing a portfolio, when you are allocating your assets to different asset classes, it's important to have a share across the both. You want to have that like a shock absorber approach. So when one's hurting, the other one's performing and vice versa. We are going to see, depending on what the Australian property market does over the next 6 to 12 months, now that people are still a bit nervous. Obviously, the prospect of interest rates falling might act as a bit of a catalyst to slowly pick up on the activity on the property market. But on the same token, whether the RBA continues to cut rates is the big question. Obviously, tariffs are going to increase inflation. RBA hates inflation, so they may not be as entitled or inclined to drop rates as much as people are hoping and expecting. So when we go through and look at the benchmarks, so what we've done here is compare the Australian All Ordinaries versus the MSCI World Index, excluding Australia. So this is like investing in Oz versus investing everywhere else, excluding Oz. And as you can see, there's a lot of polarity between the two. And that's what I was saying before about the equity markets are a decentralized global market, whereas property markets are Balmain in Sydney or Southport on the Gold Coast. Doesn't matter what it is. It's very localized in that sort of effect. So this is one of the reasons why we talk about the importance of diversification. Having three pillars: share portfolio, property portfolio, and super. By doing that, you are going to find you're having a balancing act going on when it comes to managing your money, because obviously we don't know what Albo and his boat's going to come out with. The old saying about how do you know when a politician's lying, their lips are moving, that is a big thing for us at the moment. And we know they've floated a lot of these policies in the past. They're not doing that just because they like the sound of their own voice. They're reading the market, reading the temperament, sort of determining what the next steps are. So I guarantee on day one, when they got back into Canberra, they would have started to build out a hit list of, okay, what's going to be the first cab off the rank? What's the second one? And so forth. They know they've got 6 years. A disaster would have to happen for them to only have 3. But, as I say, a week's a long day in politics and 3 years is a lifetime. So we'll see what happens there. But just be mindful when it comes to deploying cash, deploying assets in this market. Just don't go in blindly. Just take into account what might change. There's nothing worse than committing to a strategy and then with the flicking of the pen from Canberra, all that can come undone overnight. So you need to have a bit of a balancing act between both. If you're reducing your sensitivity to one asset class and one particular piece of policy out of Canberra, then what that's going to do means if something bad happens, and as advisors, we're professionally pessimists. We're always expecting the worst. We're expecting clients to get cancer because we need insurance. We're expecting Canberra to change policies. That's why we have different asset classes and different structures. The big thing for us is you can't set up a strategy or structure that is rigid and flexible, because as we know, life is not static, it's dynamic, and your strategy should be able to flow with that process. So when we go through, obviously break it down year by year with these respective governments, obviously market hit between 2007 and 13 with Rudd, so hence why that's a very low number. 2022 to present, obviously market volatility due to global inflation, high interest rates, and no major declines. And it's amazing when we think back over the last 5 months what's actually occurred. We've had Trump inauguration, Trump tariffs, Australian election, and then obviously the usual geopolitical events like Ukraine and Palestine going on as you speak right now. So historically, long-term share market performance more influenced by global trends than domestic policies. And that's one of the reasons why it should be a core part of people's investment portfolios. So now running on through to the end of financial year tips. And if I'm going too slow or too fast for a lot of folks, just chuck in the Q&A to say slow down. But obviously this time of day, I know people are eating their lunch at a desk or breakfast or about to start dinner. So I just want to make sure we're giving the information, we're not monopolising your time as well too. I'll also be sending out or the team will be sending out the slides as well from this as well too, if you do want to go back and have a look. So we're in the race to 30 June, 26 days to go as we speak today. And it might seem like a long way away, but some of the things we need to do for clients and some of the things people, expats in general, should be doing, it does take a little bit of time, so don't leave it to the last minute. Obviously, go through and look at your Australian sourced income, rental income, dividends to a certain degree. If you have left Australia recently, a partial tax year, it's important to go through and work out what your liability is going to be, potentially, because then obviously you can go through and put in place strategies to mitigate or try and correct those. Withholding tax rates are a big one. Every day we see people with bank statements and dividend statements that have no withholding tax being deducted from their accounts. What that means is the bank or the share registry that you hold your shares in think you're in Australia still. So they're not withholding the 10% that should be withheld by banks if you make any credit interest. The share registry is not withholding 15 or 30% tax if you have unfranked dividend income and depending on the country living with the DTA. It's important because when you go to lodge your tax return, you don't know about this. So therefore, technically, your tax return is incorrect. So if you don't know that they're not withholding the tax when they should, then you may have to go back in future years and update those tax returns. So you don't want to be sort of putting yourself on the ATO radar when it comes to those sort of things. So go through and look at your statement. The best way you can do it with the bank statement is, regardless of what the address is on there, go through and look at where credit interest has been paid to your account. If it says pay to your account and then the next line says withholding tax deduction of 10% of that amount, you're good. If there is nothing, then that's when you need to obviously, first of all, declare that as part of your tax return in Australia. And second of all, let the bank know that you're a non-resident for tax purposes, so they can start to withholding that tax. Obviously, capital gains tax implications. If anyone sold assets through the year, first of all, look at whether there is a CGT event, look at whether you have a liability, and then obviously what you can do to mitigate that. There's obviously a lot of strategies that can be employed. 5-year catch-up concessional allowances, even just a concessional contribution. These little things can make all the difference in the world. Obviously, you don't want to, if you are considering selling an asset between now and 30 June, if you can defer it to post 1 July, then great. If you've already accumulated gains through the year. So trying to straddle those financial years is another strategy as well too, because it brings those amounts down. If you think about a non-resident, the tax rates for a non-resident, it's 30% up to the first 130,000, 37% up to 180, and then 46% above. If you have 2 capital gains events in the same year, then your bulk of your gains will be up in that 46% range. Whereas if you can spread it over 2 years, then you should be in that lower range there. So, and obviously stay updated on residency status, critical compliance. We still meet people on a regular basis who are uncertain regarding their resident or non-residency status. As we say here in the Middle East, inshallah, it's not a strategy. And you need to lock that down, because that will affect, in turn, your declarations to the ATO, how you manage your assets, what bank statements, are reconciling as, dividend statements. There's a whole plethora of rabbit holes that jump off that topic. So make sure you have that locked down. At the moment, and the big question we get from a lot of clients is, at the moment, We're still operating on the old residency rules. The new ones haven't come in yet. So keep working on the 1936 tax residency laws. They're old, they're archaic, they're unworkable, but that's what we've got until the powers that be in Canberra decide to propose a new version, and then obviously it goes through the lower house and the upper house on that regard. Running through the rest of it, super contributions, generally not deductible for residents unless they're concessional contributions. So as I said before, if you are contributing to super, make sure your contribution has the right categorisation. We meet a lot of folks, and it's almost it's sad how many folks we meet who are making contributions into super and paying the 15% contributions tax, when in actual fact they should be making non-concessional contributions into super and not paying any tax at all. So essentially they're giving them their 15% tax-free to the ATO every year. So please don't do that. Please go through and make sure you're making the right contributions in the right categories. Obviously, file your return early with the ATO to avoid delays. Expat life, we're exhausted. It's a very dynamic experience. It's living overseas and travel and work and family. It's so easy to start to fall behind on these things. So if you do have a bit of downtime over the summer break, just nip it in the bud. Ben Turner and his team at Atlas Tax, our tax division, they love people when they come in early because they can actually 9 times out of 10 give them the most attention and time. If you approach Ben and his team on the 15th of October with a deadline of 31st of October, then guess what? It's going to be very rushed and very haphazard and not given the full process to go through and review everything in great detail. So if you do have a bit of downtime over July and August, have a look at that, get that done. Track currency exchange impacts on taxable income. People become a bit ambivalent towards what the currencies are doing, and because they've done it the same way every single way for all this time, they've just continued to do it. But just go through and have a look at these things and say, well, you know what, the dollar's fallen, so therefore more money is going in, but it's building up in the background. But every month I do a transfer, and now there's suddenly $500 more than there was before. So just go through and look at what those numbers are. If you're in Saudi Arabia or Qatar or Kuwait and you work Sunday to Thursdays, Friday is always a good day for this. You can do a bit of life admin on a Friday. Biggest thing we always say to clients is effort in, effort out. If you are taking care of the low-hanging fruit, 9 times out of 10, that's 80% of the job. Then it's the other sort of high-level stuff that needs to be taken care of. But just go through and give it the due attention, give it the efforts that it deserves, because these little things, it's just money going out the door, which at the end of the day, the ATO thanks you for that time and money, but I'm sure you don't either. Rightio, folks. So that is the end of the Q&A session. So I'm going to now throw it open to the questions. And while I'm doing that, I'm going to make our head of marketing communications, Joelle, very happy by chucking up on the screen our tags for our different social media channels. We do a lot, guys. There's the amount of content that Joe sends out from the team is without repute. There's no one else in this market that is producing as much content as we are. So when you look at the podcast, we've got the Expat Chat, Expat Mortgage podcast. So Expat Chat podcast, Expat Mortgage podcast, Atlas Weekly Recap. So there's 3 different podcast channels that clients can get involved in with us. We also have the Facebook group, the Australian Expat Financial Forum, about 3,500 people on that. Then we also have these respective pages that we broadcast out of as well too. So the biggest thing we talk to clients is there's no excuse for not knowing. We're not precious in terms of holding all the information back. Obviously, we keep the good bits for our clients. That's what they pay us for. But for the general expat population in general, we're always happy to just keep people informed and keep people aware of what's going on. Right, I'm just going to have a quick glass of water while the questions are coming in. Just give me a sec, guys. Okie dokie, so let's get the first question out of the way. Thank you, Anonymous. It's going to hit our farmers hard. Oh, this is with respect to the $3 million super tax. Most of them have been advised to put the farmers in their SMSF, especially when the $1 million allowance was allowed. That's right, under old Johnny Howard. Stamp duty and land tax considerations are also relevant. Look, you're spot on. And that's where, even whether it's a farm or, let's say, a family who started a business that put a factory into their self-managed super fund, how do you categorise which part of the factory, the building itself, generated the return greater than 3 million? Was it from the door this way, or it's a nonsense exercise? So what happens is when we see these types of legislation imposed, Treasury will come up with an incredibly convoluted way to calculate it that has no realistic bearing on what happens in practical life. So the easiest thing to say is actually just remove it. But anyway, we've got politicians involved here. None of us agree that it should be taxed at the $3 million level. Yeah, start at 50 and work your way down over time, but definitely not 3 million. So I completely agree with your comments there. Next question. Are there any changes under the Labor government on the 4 criteria tested to be classified as a non-resident for taxation purposes? Yes, there is, and that's what I was referring to before. So back in 2015, the Labor government under the time, I think it was Mr. Rudd, requested the Board of Taxation review the tax residency rules. They're becoming unworkable, still are, and he charged them with going away and rewriting these rules. Bearing in mind, it's been almost 100 years since these rules were updated, so it's a big ask. They came back with a very surprising title for the name, Modernising Tax Residency Rules, and put together sort of a 3-stage process in terms of determining residency versus non-residency. Where it's different from the current one. The current one's very ethereal and behaviour based. Where do you reside? Where's your domicile? Not exactly tangible sort of measures. Whereas under the new rules, they're very prescriptive, very, very black and white. So rule number 1, and once again, this is the proposal, so don't take this as gospel, but it is the proposed changes. Rule number 1: have you spent greater than 183 days in Australia? If you have, then you're a resident for tax purposes. Doesn't matter. Simple as that. If you haven't been part of the inside Australia for greater than 183 days, then you go to, and that's what's called a bright line test. Then the next level is, have you been in Australia for less than 45 days? Now, the 45 days, it's up for debate, and I'll explain in a second. But if you have been in Australia for less than 45 days, you are unequivocally a non-resident for tax purposes. The ATO can't go to you to say you're a tax resident. They can't take you to court. It is black and white. That 45 days, when the Board of Taxation referenced that law as part of that recommendation, they kept harping on about they're going to try to balance off the new rules with the UK and get some sort of commonality. However, the geniuses picked the wrong rule. So what they should have done was selected 90 days. Now, the rule in the UK is, it's not have you been in the UK for 45 days, it's have you been working in the UK for 45 days. Whereas the Board of Taxation and the government are saying, no, it should not just be working, it should be anything. There are holidays or whatever it might be. So, yeah, we highlighted them of that error, and we haven't heard back from them yet. So we'll see what happens there. We had heard through the grapevine that they might be okay with 60 days. The market is calling for 90. If they want polarity between the UK and Australian tax laws, they should make like for like. It should be 90 days. But as we know, we'll see that when we come to it. So, and then if you have breached greater than 45 days, but less than 183, then we have these 4-factor tests. And you only have to fail 2 of the 4 in order to be deemed a tax resident. Number 1, pretty much everyone fails. Are you an Australian citizen? Do you have right of abode in Australia? And the answer is yes, then you failed 1. So most people with links to Australia have that. The second factor test is what we call the family factor test. Do you have a husband, wife, partner, spouse, de facto, kids under the age of 18 living in Australia? And the answer is yes. Then guess what? If you have an Australian passport and a family in Australia, you're a tax resident. If you don't have family in Australia, you move on to the next one, which is called the accommodation test. And the accommodation test is, do you own taxable Australian property that is not permanently let out? Now, where this is, I'm sure, whether they might or not, but I'm sure Canberra didn't aim to target this, but there are a lot of expats now who rent out their properties in Australia as Airbnbs, which would mean it's not permanently let out. So they could potentially fail that. Or if you've got a property in Australia that you come to visit back and forth, once again, you'd fail that as well too. And the last one, which you haven't failed the family or the accommodation test, you'll probably fail anyway if you do own property, is what we call the economic assets test. And the economic assets test, amongst a range of other things that may or may not affect some people on the call, but by and large cash balances in a bank. They haven't told us what large means yet. in terms of the size. We suspect it might be 250,000, but watch this space when we know more, when you guys will know more. The second one is taxable Australian property if you own a house. Third one is if you're a beneficiary of a trust. So I'm sure there's a lot of people on the call who are beneficiaries of their family's trust or their parents' trust who probably don't even know. So if you are in Australia greater than 45 days, have an Australian passport and or have property or beneficiary of a trust, guess what? You're a tax resident. So you can see why everyone's trying to push out that 90 days, because 45 days technically is quite a short amount of time. And also to, once again, they've referenced the wrong comparison. So I hope that answers your question there, Anonymous. Okay, can you say a few words on how the new non-resident CGT withholding works on property sale? I understand 15% is withheld on the sale price. Can sellers then expect to get some of this back if it's the sum of all the income in the financial year? No, so the way this works is it's a capital item. So when you look at a ledger item inside the Australian tax regime, you've got capital items, so buying and selling assets, and then income items, which are rental income, dividend income, wages, and so forth. When they're calculating the 15% non-resident capital gains withholding tax, what they're virtually doing is, let's say you sold the place for $1 million. The person buying the properties, the conveyancer sees that you're a non-resident and follows the rules as stipulated by the ATO, and they will withhold 15% of the $1 million purchase price, so 150,000, and they give that to the ATO. When you lodge your tax return the following year, depending on whether you made a gain or not, you will either pay more tax. So if instead of 15%, you should have paid 30%, you'll pay more, or vice versa. If you meant to pay less tax, then you'll get a refund. You can ask for a variance certificate from an accountant that can be submitted to the ATO. So, for example, if you won't go to crystallise a gain, or you're selling a former principal place of residence under one of the life event exclusions, where you don't have to pay capital gains tax, these sort of things you can approach an accountant in advance. Don't leave it to the last minute, because it does take time. Approach an accountant, request a variance certificate, that gets sent off to the ATO. And once you get that back, you can then provide it to the buying party of your property to say, yes, I'm a non-resident, but I got a clearance from the ATO that says zero should be withheld. So don't need to worry about the income side. It's all on the asset sales side. So I hope that answers your question. Okay. Could you please give an example of making contributions to super under the right category versus the wrong category? Thanks for the information. Yeah, look, so essentially there's two pathways into super from a contribution point of view. The first one is what we call pre-tax, and that's what's called concessional contributions. If everyone casts their mind back to when they're working in Australia and their employer would withhold a percentage of their salary to put into super, and then you get paid the net difference, that's essentially what concessional contributions are. It's pre-tax. So if you earned $100,000 salary and the super guarantee rate was 10%, then they withhold 10% of the 100 in terms of the salary and put that in your super. And then your marginal tax rate will be calculated on the 90, what's left over. Obviously, if you do take out 10% and they goes into super, you're bypassing the marginal tax rate on the remaining portion of those incomes. So that's why there's we call a 15% contributions tax, to stop people avoiding tax in terms of directing all their salary, or a large majority of it, towards super. So that is a pre-tax contribution. Obviously, as a non-resident, you aren't employed by an Australian employer, so you don't have super contributions. So you have these unused allowances, which to date is now $30,000. It's sort of been going up 25, 27.5, 30,000 based on indexation. What that means is you can contribute cash to your super account as a concessional contribution, but you would be taxed at 15% if you categorize it as that contribution. The only time you would look to use a concessional contribution is if your property was generating positive cash flow after all deductions, or if you sold a property which realised the capital gains event and you wanted to use some of the proceeds to reduce the assessable gain on that. I won't go into that too much today. It's a bit more than what we're here for today. But long story short, you only put money, if you're just putting money away to save, do not use concessional contributions. There's a non-concessional contribution allowance, completely different, which most people have never used when they were, especially when they were a tax resident. And this is a way you can contribute money into super as a non-concessional. So what that means is you put in $100, $100 is added to your account, not 85. They're not withholding back any contributions tax. So by doing it that way, you're getting dollar for dollar into your account. The limits on non-concessional allowances are a lot higher too. So $120,000 a year. And if you're looking at retiring soon, or you have a lump sum of cash you would like to get into that, you can actually use what's called the 3-year bring forward rule, where you go and grab the next 2 years worth of allowances, combine that all together to $360,000, and you can make a lump sum contributions into super for $360,000. So that's a big one as well too. So hopefully, Anonymous, that answers your question. There's 2 contributions. Talk to your super fund about how you make either one of those contributions. Okay, next one. Are CGT events based on the date of sale, e.g. the exchange of a contract, or the date of settlement? This is in regards to your suggestion of spreading CGT events over multiple financial years. Good question. And not a lot of people realise this, but it's actually the date of sale, the date you sign the contract. So that's the big one, not when you receive the cash. And that's an important one. So people get caught out when they're about to become an expat, and there might be a delay in trying to sell their PPR because they're trying to avoid paying big capital gains tax on the main residence exemption that they're not entitled to anymore. And they go, well, I'm going to fly to the country now. I'm going to sign the contract overseas next week, and the property will settle, in sort of 30 days' time or whatever. But yeah, it doesn't work like that. You need to make sure it's the date the contract is signed is when it actually happens. So it's different to income receipts. Income receipts are based on the date that you're receiving the money. So it's actually based on a cash accrual basis. When the money hits your account, you pay tax that financial year for that. With property, it's all about the date that the contract is signed. Rightio. Okay, Brendan, good question. Hi, if I own a property that is negative geared in Australia and I would like to contribute to my superannuation, would it be better to make a non-concessional contribution? 100%, mate. That's the best way to go. If you think about it, you've got a tax deduction, you're running a negative cash flow, so therefore you don't have to claim a tax deduction. Where you would make a concessional contributions owning a property in Australia is, let's say, for example, you owned a property and it generated $20,000 in positive cash flow after all expenses. At that stage, what would happen is, as a non-resident, you would pay tax at 30% on that 20,000 and to the ATO, and you keep the rest. What you can do is, before 30 June, take that 20,000 in positive cash flow that's been given to you by tenants, put that into super as a concessional contribution. Because remember I said before, when you put money in as a concessional contribution, it reduces your assessable income by that amount. If you put $10,000, $20,000 or $30,000 into super as a concessional, your assessable income in Australia after deductions and costs reduces by that amount. So if you generate 20,000 positive cash flow, put that into super as a concessional, your assessable income goes to zero, and you only pay 15% tax on the contributions tax. So I hope that clears it up for you. Okay, next question, Theo. Can you speak about avoiding the 15% tax on super contributions as a non-resident? How would one tangibly do this? Mate, very easy. Speak to your super fund or speak to your advisor and get them to do the work for you. That's what we do for our clients. We obviously tell clients which pathways, which avenues, even just the functions of actually contributing the money itself. There's different BPay codes or different bank accounts you need to use. You need to speak to your super fund. You can also, if you have made contributions in this financial year, speak to your super fund about getting those contributions recategorized as non-concessional. That's a way we can normally save clients the most money very, very quickly with no skin off our nose. Speak to your super fund and say, hey, I made a mistake. This money went in as a concessional. I didn't mean to do that. Meant to go in as a non-concessional. Some do, some don't. So your results may vary, but definitely speak to the fund, speak to your advisor. Your advisor would know all about this, but if you don't have an advisor, speak to the fund and just be insistent on you wanting to be able to make a non-concessional after-tax contribution. So pre-tax is before tax, non-concessional is after tax. It's actually money out of your own wallet, money that you've earned and paid tax on. You can take it to the casino or put it into super, that sort of money. You just want to insist on that. That's the case. Okay. Next question. I'll be spending more than 45 days, less than 183 days a year back in Australia, where most of the time will be in vacation. I live and work in Switzerland. Are there any tax implications I need to be aware of? Look, there is. And it's probably a bit too long to go into detail on this. So long story short, it's not just the 45 days less than 183, because guess what? That rule is not even in place yet. We still deal with the existing rules. So the existing rules are the resides and the domicile test. And the ATO, as is the ATO, they wax and wane when it comes to the application of the rules that are in their own favour. So what that means is you can be classified as a tax resident of Australia without even being there greater than 183 days. You know, there was a gentleman here recently in Dubai who was working for an Australian company, lived in Dubai for 5 years, never went back to Australia more than 4 weeks. So we're not even talking greater than 30 days. Yet he had a wife and kids in Australia, he had cars in Australia, and the ATO said his life in Dubai is temporary in nature, and therefore they, believe it or not, actually looked at photos of his furniture and said that's IKEA furniture, that's not permanent. So just because you're less than 183 does not mean that you're safe as houses. So definitely recommend you get in touch with us. You know, Ben Turner, who's our head of tax, does these calls all the time, does these tax determination calls. So I'll just put on the screen there a website at swealth.com. You can get in contact with us and we'll put you in touch with Ben, because it's not just the day count. It's, you know, the resides test, the domicile test, and the 183-day test. You can pass the 183-day test, you can pass the resides test, but if you fail the domicile test, that's all it takes. So, okay, next question from James. Jamin, sorry. So, living in the US but have cash in an Australian account and paying tax as a non-resident for tax purposes. Can you talk about the best options on how to invest and minimise tax rates? Gentlemen, you have picked an interesting country to reside in. And the reason I talk about that is because the US's scope for worldwide taxation, both on citizens and residents as well too, which you'd fall into. So where it gets, if we look at this from the Australian side, as you leave the country, asset classes split into 2 categories: taxable and non-taxable assets. Taxable assets are Australian property, house, apartment, block of land. You continue to accrue a tax liability. You don't get access to the 50% capital gains discount. On the non-taxable side, by virtue of its name, non-taxable, you don't continue to accrue a tax liability with the ATO. If these are assets held or purchased before you depart, then you need to make sure you look at deemed disposal. But that's, once again, another topic of conversation. You can Google deemed disposal Australian expat, and you'll see one of our blog articles appear. What it means is you can buy investments as a non-resident in an account in Australia, and you do not accrue a tax liability with the ATO. So share portfolios are becoming more and more popular with expats because of that reason. Now, being resident in the US, here's where things get a little bit more complicated for you. So back in 1985 or 84, the US brought in this great rule called PFICs, passive foreign investment companies, which meant that if you are a tax resident of Australia investing in an asset overseas that is passive in nature, and when I say passive in nature, it's not a business. So BHP, they dig stuff out of the ground. Telstra makes people's phones ring. An ETF, that's overseas. That's passive. They're just buying other assets and living on the income and the growth. Then they will tax you at the top marginal tax rate in the United States. So we actually have US portfolios for our US clients where we can house the assets in Australia, but we own US domiciled assets inside that Australian account. And that enables you to not be punitively affected by the PFIC rules. So jump on, I highly encourage you to get in contact with us, because James Ridley and his team, who runs the Australian office, they are specialists in the US and they've got this thing down pat. We've been doing it in the US for 13, 14 years now. And we have particular portfolios in the US we run specifically for our clients in that region. Okay, next question. Theo, Brett, sorry, no, sorry. I answered a Brad, Greg, all of that, so don't be too worried. Another question, has there been any progress on a UAE Australian double taxation treaty? What is the real difference in not having one? Great question. The honest answer is the chance of us having a DTA is slim to none. The Australian government and Treasury in particular are not fans of having DTAs with countries where there is no personal income tax or even high levels of tax at all. So that might change over time. If you think about Singapore, 15% tax rate, there is no DTA with Hong Kong. So I think the chance of having a DTA with Australia is slim to none in the foreseeable future anyway. If we look at, say, for example, the latest agreement, which is the CEPA agreement, which is an economic partnership agreement between UAE and Australia, that handles things like trade tariffs and that sort of stuff, which is obviously quite topical right now with the US. One thing I'd like to say to the folks on the call is if you are in the UAE and you are paying 30% withholding tax on your dividend income because you reside in the UAE, get in contact with us because that's the wrong tax rate. There is another rule which we employ for our clients that cuts the tax rate in half. If the country you reside in has a DTA or is a part and a signatory of an information sharing agreement, which the UAE is with Australia. So what it means is if you own shares in Australia that are unfranked and someone is withholding 30% tax from you, you need to change it to 15% tax and get in contact with us because that's another way we save clients a lot of money as well too. In terms of other things, the double taxation treaty protects. Obviously, if you the new rules come in, for example, when you breach the 45-day and you have a passport and a house, and the ATO goes, you're a tax resident of Australia. If you reside in a country that has a DTA with Australia, there'll be an item called a tie bracket clause, which says that you cannot be classified as a tax resident of two countries, and it defaults to being you're a tax resident of the country you reside in. So clients in the United States, Singapore, UK, they will never have that issue because even if they breach the 45 days in Australia, the DTA says that the ATO still can't classify them as a tax resident. So that's an important consideration. I'd love to see that in the UAE and Saudi and Qatar and all the areas we've got under our responsibility here, but I can't see it happening anytime soon. Question from Grant. If I return and become a resident, how difficult is it to be redeclared as a non-resident? At the moment, not too difficult. Under the new rules, Grant, horrifying is the best way to describe it. And the reason I say that is they're going down the route of what we call adhesive residency. So right now, if you go back to Australia, you change all your statements over to say I'm a resident and utility bills and your actions look that of a resident. And then 12 months later, you decide to come back out again. As long as you abide by the resides domicile 183-day test for the next 2 years, then you're a non-resident from day one. Under the new proposed rules, this is a bit horrifying, especially for folks in the Middle East. What it says is if you are leaving the country and you have an employment contract for 2 years, then you're a non-resident from that date you move out. If you leave the country with no contract and you fly in, let's say to Dubai or Abu Dhabi or Saudi or Riyadh and are looking for a job and then become a non-resident, you're still a tax resident until 3 financial years, and then they deem you as a non-resident. So word of warning, if you are looking to become a non-resident, do it before the rule changes, because after the rule changes, they're getting very, very difficult. Okay, next question. Do you have any comments on the proposed US remittance tax law? This is a juicy one. And I think OFX were the first to break this last Friday, and we were the second. Just for the folks on the call today, as part of the big, beautiful bill that Trump has put together, what he said was any non-citizens remitting money out of the United States, there'll be a 3.5% tariff on those amounts. Pretty crazy. So what it means is if you have $100,000, you live in the United States and you're trying to transfer it back to Australia, you'll be 3.5% poorer off before the FX rates. Now, where this gets interesting is the way that US politics works is they vote on the bill, but the devil in the detail doesn't get added till after the vote. So we still don't know a lot of details. Where my mind goes to is if I'm resident in a country that uses the US bank as an intermediary for my transfers, even though I don't live in the United States, will I get taxed or charged the tariff? If I have US domiciled accounts, so interactive brokers, number one that comes to the top of my mind. If you have an interactive brokers account and move money out of IB, does that mean even if you don't live in the United States, because the money's coming out of the United States, does that attract the 3.5% tax? So long story short, Anonymous, we don't have all the details yet. We are looking in this incredible great detail. As soon as we know, you'll know. We'll obviously put a lot of information out on the socials and also on the emails as well too. So, but yeah, it's a doozy. It's probably one of the biggest changes since MRE rules back in 2018-19, as far as I'm concerned, for US-based expats and potentially anyone with cash inside the US. Another question from Anonymous. If you transfer a considerable amount of term deposits after July back, how will this affect your next year's tax? So I'm assuming you're transferring cash into Australia and then putting into a term deposit. If that's the case, then essentially 10% capital non-resident withholding gets withheld and you take the 90%. So there's no real limit on that. Yeah, with the non-resident withholding tax, there's no stepped amount in terms of different amounts. You can put a $10,000 term deposit together, or you put a $10 million term deposit together, and both will be treated the same way from a 10% withholding tax rule. Another question here from Anonymous. If living in the UAE but still working for an Australian company, does getting paid superannuation deem me a resident for tax purposes under the current laws? Anonymous, look at the address on that website. You need to contact us today. We have been working with the ATO on a number of matters, one of which for a client was someone who's working overseas for an Australian company. And some of the things that the ATO said to us are quite scary in terms of doesn't matter if you meet the resides domicile and 183-day test, you're still a tax resident. So please get in contact with us because that's something we need to attend for you very, very quickly. It's not the end of the world. Things can change. You can change the status of your contract and those things. But please don't assume that because you're living in the UAE that you're a non-resident, especially when you're working for an Australian company. So please get hold of us and we'll get you in front of Ben because, some of the emails we've received in the last couple of months from the ATO have been quite scary. Okay, next question. Is the 45 to 183-day rule apply to calendar year or financial year? Financial year. So what that means is you can straddle 2 financial years. So you can be in Australia for 60 days, 15 days each. 30 days on each side, and you haven't exhausted your allowance either two. So it's look, we want it to be 90, but it's we'll see what Canberra says. Next question. Why would I contribute extra as a non-concessional to super when I can just run my own share portfolio? If they invested in exactly the same assets, would the super pay less tax and get a compounding benefit versus me paying tax on every year on dividends? Good question. And the answer is it's all in the execution. So say, for example, you put your money into Australian super, which is what we call a pooled super fund. A pooled super fund is virtually the communist way of investing. Everyone shares in the gains and the liabilities, the tax credits and the tax losses. There's another level up, and that's called a retail wrap super fund. And then the next level up from that is an SMSF. Expats can't use SMSF, so don't consider that. It doesn't matter what people tell you. So middle level there, retail wrap. Now, in these accounts, you are the direct beneficial retail owner. And the reason for that is if you look at your Australian super account or host or rest, you'll see 565 units of the balance fund or whatever it might be. You own the trust and the trust owns the underlying assets. Under a retail wrap super fund, which is a little bit more expensive, I'm not going to lie, but the benefits are tenfold. What it means is you can own BHP, you can own Telstra, you can own NVIDIA, you can own Meta, but you own it. It's your cost basis. Now, the most important part of this, and coming back to your question before regarding less tax, is as a non-resident in a share portfolio, you're paying either 15 or 30% on your unfranked dividend income from a tax point of view. inside super, because it's agnostic with your resident, non-resident, it's just a 15% income tax. Now, if the dividends being generated inside of that portfolio are franked, which come with a 30% tax credit, that immediately extinguishes the 15% in terms of your income tax. So you might think, oh, big deal, I do that with my share portfolio. But this is where the beautiful thing about super is, over a compounding basis over a long period of time. The ATO refunds you the unused portion of the franking credit in cash into your account every year, which can then in turn offset the withholding tax on unfranked dividends. So in 12 months, might make a bit of a difference. You pay little to no income tax, but imagine that compounded over 10 years. It's huge. So yeah, that's probably a good example of why you'd contribute extra as a non-concessional. The big question is liquidity. If you can afford to say goodbye to that money until age 60 and you want that forced savings, then definitely that's a great strategy to use. If you want to be able to put your hand on that money in 5 years' time and you're below the age of 60, then yeah, then you continue down the share portfolio route. Okay, last question. My business is in Oz and I generally swap countries each year. Last year, UAE, this year, Thailand. Up until now, I've classified myself as an Australian resident, even though I'm barely in Oz. Should I get in touch with Ben Turner? Look, not really. I think it's the ATO is always happy for you to declare yourself as a tax resident. So the only time that you'd need Ben would be if you went at odds with what was in the ATO's favour, if you know what I mean. They would love everyone to declare themselves as a tax resident because they'd be getting a swarm of cash from everyone. So if you are declaring that, then no, you just file your tax returns as normal. You might have some different tax rules to consider, but nothing too complicated. So I think you should be fine there. He's a nice guy anyway. He's from Adelaide though, so don't give him a hard time over that, but top bloke. Next question. Do the new tax rules potentially affect international pension bonds? In new tax rules, you're referring to the 3.5% tariff or the non-residency? I'll answer both. So on the 3.5% tariff, no, that's not a US domiciled account. On the residency side, no, but I'm just going to state some facts here that there is a lot of mistruths and rumours and false information out there about international pension bonds. There's this whole argument to say that you can hold these things for 10 years and you go back to Australia and draw this money down tax-free and everything. And in theory, that's correct. 95% of the times we see the stuff that these offshore advisors, who aren't really advisors, they're insurance salesmen, put into these bonds are absolute rubbish, structured notes and all sorts of stuff. And the rule of thumb we say to clients is if people are stuck in these accounts, if you get your money back after 10 years, you're doing well. That's actually a really good result. So the fact that you haven't made a capital gain is almost moot to the point. For those people who are, and I'm talking only 5% of people we see with these bonds actually make money out of them. What has to happen is, whether it's Friends Provident, RL 360, they have to go to the ATO every year and ask for a private ruling to say that they want to be treated the same way from a taxing point of view as Australian bonds under the FIF, the Foreign Income Fund regulations. Now, the third thing behind that is if you put money into an Australian bond, the Australian bond provider pays 30% tax on your behalf to the ATO. And by doing that means that if you hold it for 10 years, that's why it's tax-free. They're paid tax for you. I guarantee Friends Provident, Generali and RL 360, they're not paying any money to the ATO. So if the ATO decides to take a change of view in terms of the winds of change happen and they decided to not treat these funds the same as domestic funds in Australia, then there is a chance. And I don't know if this will happen, but it's a risk. As I said, we're professionally pessimists when it comes to our role. There is a risk that the ATO 1 year could say, you know what, unless they start paying the 30% tax like the Australian bond providers do, we're not going to give them the same exemptions. So I guess it's a very long way of answering your question, Anonymous, but do the new tax rules affect international pension bonds? No, they don't. But what you need to be more worried about is the year-on-year private rulings that these pension providers apply to the ATO for. Because if the ATO changes their mind, and they do it a lot, then that may be the case. So I hope that answered your question there. Right, guys, any other questions? Speak now or forever hold your peace. Okay, I think we let everyone get on with their day there. So thank you very much for your time. We've just gone just over an hour, so apologies for those who were relying on it to be under by 6 minutes. Thank you very much for everything. You guys, these things, we value the question, especially the Q&A at the end. You know, I might come across as a bit flippant stuff, but it really means a lot to us because your questions are others' questions as well too. So thank you very much. We'll send out a copy of the slide deck as well too for everyone. Just keep for your records. Any and all questions, you know where we are, atlaswealth.com. Follow us on all the socials, Facebook, Instagram, LinkedIn. If you're into podcast, Expat Chat podcast, Expat Mortgage podcast, Atlas Weekly Recap podcast, you know, subscribe to that. We've got weekly episodes coming out all the time. I don't think there's any more information that Joel could physically get out to you guys as quick as she does. So it's all there for you. If you want to use it, fantastic. And if you want any more further chats, deeper dives, then hit us up at atlaswealth.com. Thank you very much, guys. Cheers.